to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. Today we're talking to a man I would describe as a quiet achiever. He's a humble fella, but his results have already got him in the top 1% of property investors in Australia, and we unpack how he got into that position, his passion for property, and what the future holds for him in his property and his business. We're talking to Eric le Tran from Eric le Tran Property. He shares some insights into mistakes that he made early on in his property investing career, the difference between houses and apartments and the drivers that affect both of them. We also talk to him about the state of play in the buyer's agent industry at the moment, the difference between some of the big agencies and the boutique services and where he thinks the value proposition is at. He also shares some insights and advice for people that are in the beginning of building a portfolio, for those investors that are trying to get a sizable portfolio, what he thinks are the most important things to focus on. It's an awesome interview with a very considered and well-spoken, quiet achiever, as I said. I'm sure you're going to get something out of this one. Here's Eric. Eric le Tran, thanks for joining me on Geared for Growth.
Thanks, Mike. Good to be here.
I've been looking forward to this one for a while. We had a little bit of a preliminary chat, I think maybe a month or so ago now, but finally get to get stuck in because you've got a pretty amazing story and have achieved quite a lot of success in a very short time. And I think all the listeners are going to want to hear us unpacking that. Let's start with your own property journey. What was the first sort of catalyst that sparked your interest in property and property investing?
Yeah, so for me, property was something that I've always kind of been interested in, investing in general. But it all kind of started like when I had just kind of graduated from uni. I was in one of my first jobs out of uni as a graduate. I have told this story a few times before, but during my first few months of, working in that job, I kind of made friends with one of the guys on the floor, and we'd make a little bit of small talk. And then one day he just asked me what I did on the weekend. I asked him what he did on the weekend. And he said, look, I was out, inspecting houses to buy for myself. And, he pulled out his phone and he showed me these just absolute like mansions, right? Like beautiful houses. And I just thought, I just made a joke and I said, oh, wow, I'm in the wrong profession. I should have become a lawyer, because he was a lawyer in the company. And then he just kind of shut me down right there and said, no, my job as a lawyer has got nothing to do with me being able to, be in a position to buy these houses. And the only reason that I'm in a position to, start looking for these types of houses is because I've been investing in property for a very, very long time, and now built up the wealth to now potentially buy my dream home. And then when he told me that, I just said, teach me.
Yeah, I'll have what you're having.
I want to learn how you're doing it, given that I'm at the beginning of my career. And he says, absolutely. And then since then, we became really good friends. He became like a mentor to me. And then he started just teaching me about a lot of the fundamentals of, property investing, and then just guiding me along the way. So that's kind of how I first got introduced into the industry, or not the industry, but into property investing in general, and learning about the potential outcomes that you can achieve if you do it well. So, so from there on, I started, saving up to buy my first property, building the equity from those, and building up my portfolio, and obviously learning from other people along the way, and the journey just kind of unfolded from there.
Yep. And talk us about the first property. How did you save for that? Where'd the money come from? What sort of location?
Yeah, first property was, so I bought with my wife. So at the time, we were, getting engaged. And so we wanted to build our wealth together. We were kind of stuck between, do we buy a place to live in for after we get married, or do we rent? And with the advice of my mentor and my friend at the time, he always talked about the idea of rent vesting. That's where I learned about that concept, where you rent where you want to live, invest where you want to make money. And because Sydney was just so expensive, it's always been expensive, but from the salaries that we were on, the types of homes that we wanted to live in were not really available to us with the incomes that we were on.
Yep.
Okay, unless we were to compromise on where we wanted to live or the types of properties that we wanted to buy. So it just made more sense to buy an investment property. So with our budget, we ended up buying an apartment out in Blacktown,
Mm-hmm.
and everyone knows that was a terrible investment. So that one didn't perform well.
Yep.
The original intention was for us to buy a house in Blacktown, but by the time we'd got our finances ready and the market was just so hot,
It went crazy, Blacktown, actually,
it was
at a point
crazy
in
at the
time.
time. I think in 2015, yeah,
Yep.
absolute crazy. Prices were going up by 10, 20 grand every week. And by the time we had our finances and pre-approval ready, we were already priced out of houses. But because we had been, inspecting properties there for like every weekend for like a good few months, we knew the area well. And we're just like, geez, oh, well, let's just buy an apartment here. Okay. Since we know
Yep.
the area well. And we thought was a good idea because it was still Blacktown and it was an area that was doing well. But little did we know that houses were primed to perform well in Blacktown, not apartments, and that's
Right.
what happened. So we bought that property. It didn't perform hasn't really performed for a very, very long time. But that was one of the big learnings at the beginning, a very hard learning that we learned early on.
Yep. And if you look at the stats from the ATO, most property investors don't get past one property. And I think you've highlighted one of the key reasons, I think, why people don't go on from there is that if you get the first one wrong, it can cause you a few issues. It can make you fall out of love with property. It can put you in a financial position where you're actually struggling to maintain the cash flow just to hold the thing. How did you overcome the first one not being the dream one and push forward from there?
Yeah, so we were lucky that at the time, even though it wasn't growing, it was at least positive cash flow or neutrally geared. So the rent
Yep.
was able to cover all of the interest repayments and the strata. So it didn't cost us anything to hold. So therefore, we just held it. And
Yep.
during that time, we just worked hard to build up our savings to go again and buy another property. So we did have some money left over in savings, and we just built up our savings again. And then when the time was right, I think a couple years later, we decided to go again. But then Sydney prices were already way too expensive, so we thought Brisbane was the way to go.
Yep.
But we were never going to go and do it ourselves in Brisbane, and that's where we hired a buyer's agent. Yeah, luckily, a good friend of mine was a buyer's agent who knew the Brisbane market really well, and he'd helped us get into that market.
Yep. And for the benefit of people listening, can you share as much as you're willing to, fast forwarding to today, where you're at with your portfolio?
Yeah, so basically we bought that second property in Brisbane, and then that was 2016. And then, as of today, eventually we ended up building a portfolio of 7 properties worth almost $5 million.
Yep.
Okay, so 4.8 to 5 million. So we got the property as high as, we got the portfolio as high as 7 properties worth about 5 million. But I've since let go of that first investment property in Blacktown because as interest rates went up, the holding costs were just too much. And for me, I just felt it was best to, cut my losses for a property that's negatively geared but not growing. So right now we're down to 6 properties. Currently looking to replace that one. Yeah.
Yep. I mean, it's a funny thing to say. Obviously, you're very driven. You've got the goals, but you're 3 or more properties. You're less than 0.5%. You're in rarefied air of investors in Australia. So how hard was that for you to make that decision? Because we are kind of taught as investors, you never really want to sell. You got to hold the things, right? But there are obvious times where you have a non-performing asset that's actually costing you opportunity to be able to go elsewhere. I mean, that is a commitment of capital sitting in a place where you've lost faith in its ability to grow and to cover itself. How did you deal with that?
Yeah, it had been a build up over time. So we were always just kind of monitoring the market. We knew that our fixed rates were going to come to an end. And when that happened and we're going to roll over to variable, then our expenses our holding costs would significantly go up. Yep. So I kind of had it in my mind to do that. And when that happened, I kind of monitored the market again. Didn't look like it was going to get much better. And then at the end of the day, it wasn't a very emotional decision. It just made sense because it was costing us almost $2,000 a month in negative cash flow just to hold it. And I just felt, well, if the property's not growing in value, but it's costing us $2,000 to hold, then there's no point holding it. It's better to cut the losses now before we just continue to bleed more cash.
Yeah.
But and to put that into perspective, I have other properties in my portfolio that are negatively geared as well. By some are negatively geared by $1,500 a month, maybe a little bit less. I've got another one. One of my Brisbane properties was close to $2,000 a month in negative cash flow. But the thing is, I'm okay to hold that one because I know that it grows in value by more than $2,000 a month anyway. So in the long term, it's worth, paying that negative cash flow now for an asset that is growing in value. But for that Blacktown one, it was like, no, there's no point. So it made more sense to just let it go and just cut the losses. So it was a pretty easy decision. And I guess it was made easier by knowing that, we were quite frustrated about that property for quite some time.
Yeah. You're probably glad to see the back of it, right?
Oh, yeah.
It's funny, we're talking about cash flow position, which in many respects is just an after-tax kind of outcome of owning the property. Whether it's positive or negatively geared isn't intrinsically a good or a bad thing. Of course, when you're having to manage the cash flow or you're trying to go back to the bank, the cash flow position kind of matters. But if it's negatively geared by $10,000 a month, but it's growing at $1 million a year, I mean, that's a good deal, right?
That's right. Yeah, that's right. Yeah.
So after Brisbane, talk us through the next properties from there and what maybe the Blacktown property kind of helped to inform you to avoid in future.
Yeah. So one of the biggest lessons I learned from the Blacktown property was that sometimes buying in your own backyard is not the best idea. Okay. Yeah. Like when you get started with property investing, it always makes more sense to, be able to drive to the property in your city, inspect it, touch it, feel it. But the thing is, like, if your home city is not the market to be in when it comes to an investment property, or it's not the right time to buy an investment property, it might be worth considering opportunities elsewhere. Okay, so for us, like knowing that Brisbane was the place to be in 2016 made it knowing that Brisbane was the place to be was just a big eye-opener, okay, because Sydney was no longer available to us. There was a lot of talk about Brisbane, starting to grow. So it was just us thinking purely along the lines of being objective and where's the best opportunity right now. So that's the big lesson there. And the other thing is, like, a lot of people try to, stay in the city that they're in, and even if that means that they compromise on the asset type. So like, I can no longer afford a house in Sydney, therefore I'm going to go and buy an apartment in Sydney. And then we're like, okay, there's kind of two big potential mistakes there. One is buying in an area where it may not be the right time. And then the second one is compromising on the asset type, which down in the long term can cost you hundreds of thousands of dollars in lost growth. And that's what had happened with me in the Blacktown property. But it was something that I was lucky enough to correct for my second purchase, which then compounded to help me and my wife be in the position that we are today, to help us build our portfolio to 7 properties.
Yeah. That's a really interesting point, because you kind of think, all right, well, I've earmarked this area. I think it's going to do well. I've just been priced out of houses. I'll get a cheap version of a house, which is an apartment, but that's not exactly how it works. The demand drivers and the dynamics for the two different asset classes are completely different. It attracts a different type of tenant, different type of buyer, and those markets don't always move in concert, right? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah, that's right. And Blacktown's a perfect example because houses had done really, really well. Had I got into Blacktown and bought a house for like $400,000, I'd be sitting on $1 million right now, if for that value. Whereas the property that I bought was just around 400,000. It only gone up by 50 grand in the space of almost 10 years, right? And it's because like the houses were a lot more scarce in supply, whereas the apartments were just new apartments were constantly being developed in the area, which caused an oversupply issue. So that was another thing that I've learned the hard way. Yeah, is managing that oversupply risk.
Yep. So when you're looking today for properties for yourself and of course for your clients, because that passion for property eventually translated into you starting your own business, what does an A-grade investment property look like in a generic sense? I know everyone's got different goals and different portfolios, but is there something that you could point at and go, that's about where we're looking at as a sweet spot?
Yeah, so I guess my approach to picking investment properties is it's very data driven, right? So I always start off by looking at the data to pick a market, and then within that market we pick the right suburb, and then I then look at within those suburbs to see is this area looking like it's primed for growth? Can we see that there are multiple data points that show that demand is outweighing supply, or that supply is going to remain constant? And then demand will continue to go up. So that's one area that I look at. But then I also look at the qualitative factors like, who's living in this suburb now, who's moving into the suburb now and in the future, and what can that tell us about, tenant quality or future owner occupiers, and whether they've got the affordability to drive the values up in the area. Okay, so for me, I'm very big on those qualitative factors, things like affordability and socioeconomic status, because wherever possible, and whenever my clients have the budget, I always try to choose areas where the affordability and socioeconomic status is a little bit better, because I just feel that fundamentally those areas will always have better demand and drive future growth from owner occupiers. So that's kind of what I look for in, I guess you could call it like an A grade or investment grade suburb. But then within those suburbs, it's about understanding what types of houses are most in demand. So, do the locals prefer to live in 3-bedders or 4-bedders? Is it an area where, you really need a garage, or are people just mainly, commuting to the city and they don't really drive? Okay. And it's funny because if you're looking at the areas where the socioeconomic status is not as good and might have a bit of a stigma, or there's a bit more roughness to it, then sometimes it's like, okay, well, maybe you do need a lock-up garage in those types of suburbs, right? Rather than, and people don't really want to park their cars on the streets. So it's about understanding those things to ensure that you can choose, I guess, an investment grade property that the locals will demand, that the local tenants will demand, and future local owner occupiers will want to buy. So that's kind of what I look for. Yeah,
that's a great point, because I think we purchase an investment property and we think it's a long-term hold, and we don't think about who would be interested in it if we wanted to sell. But essentially that's what's driving the value. It's something that is not just something that an investor looks at and sees value, but owner occupiers as well. And they're the majority of the market in most places, right? So that's something I think we've always got to keep in mind.
Absolutely. It's I always think about the owner occupiers in the long term, because sure, there might be a lot of demand now from investors that kind of help drive the demand and compete with the local owner occupiers. But in the long term, it's the owner occupiers that drive the long-term growth. And that's who you've got to appeal to. But also, I guess when you're looking at the tenancy period, you want to make sure that it is a house that locals would want to be tenants for as well. Because if my property is ever vacant, I want to make sure that if I put it on the market, that the good tenants in the area want to apply to rent my property over the other one down the street. And that's kind of something that I have learnt the hard way as well with some of my properties, where it's like, oh yeah, geez, I really need a tenant, but they chose that apartment over mine because it was on a higher level and had more natural sunlight, like things like that. So it's about just kind of understanding what will the tenants want to rent as well, because it makes the difference between your property being leased in 1 or 2 weeks versus like a month.
I want to unpack something about, you spoke about offline a little while ago about your business and your brand as a boutique buyer's agency business, and you've got no real goals to grow into a massive enterprise because you believe there's a sweet spot for service that some of the big scale agencies can't kind of get to. And it does feel sometimes that it's almost like you get to the end of their waiting list and they're like, here's the property we recommend for you. And why? I'm like, oh, it's just good value. Whereas they're not necessarily considering what their long-term goals are, what they have already, if they've got a portfolio. What's your kind of view on the state of buyer's agency in Australia now? Because it's definitely an area that's exploded, and the amount of transactions that buyer's agents are across now compared to years ago, I don't have the data, but it would be way more than it was.
Yeah, I think a lot of people in the industry can see that there's a lot of buyers agents, I guess, coming into the industry, which is it's good for the real estate industry. But I do feel that there are a lot of buyers agents out there who are purely focused on finding a property for their client, making money, and moving on, and that's perfectly fine as long as you find a good property, it meets the client's objectives, and it does well, right? And the clients are happy with that. But for me, my approach is, of course, I've got to do that as well. But I do believe in giving some education along the way and giving value, because ultimately buying a property is a very big decision for a client, for anyone. Okay, it's probably the biggest purchase that they will make in their lives. So therefore, if they're going to put their trust in me as a buyer's agent, then, and I'm going to recommend a property, then the least I can do is explain to them why it's a good property, why it's in a good area. So I'm very big on educating them on where we're buying, why we're buying there, and why this particular property is a good buy. Because I think for me, in my experience as a buyer's agent and talking to clients who have worked with other buyer's agents, I often hear them say, hey, I bought this property in this area, in this suburb, and it hasn't performed well. And then I said, okay, so when you bought that property, like, why did you buy there? Or why was it, recommended to you to buy in this particular suburb? And they'll just kind of shrug their shoulders and say, I don't know. The buyer's agent told me to buy it. I trusted him or her, and I bought it. And it didn't perform well. And I thought, okay, well, I don't really want that experience for my clients, because, and I don't ever want any of my clients to go to a barbecue and say, hey, I bought this property in, call it, Perth. And then they say, why'd you buy there? And they say, I don't know, Eric told me to, so I just trusted him. Like, for me, that's not what my experience is about. It's about them being able to explain, I bought in Perth for these reasons. This is the part of the cycle that Perth was in. This is the suburb that we bought in because these are the types of people who are moving into the area, and it was going through a growth cycle or anything like that. Okay, because it's about my clients kind of like when they buy a property and they sign a contract, they sign it with confidence, knowing that they're about to make the biggest purchase of their lives, but they know why they're buying it. And when they explain it to their friends and family, they're able to basically tell them why they bought it and have confidence in that, rather than saying that they put their blind trust in me. Okay, so, and I just think that, if someone's going to pay a good fee to a buyer's agent for a big purchase like that, it's only fair that they get that level of education.
Yeah, I completely agree. What do you think it comes down to? Is it about just the volume and not necessarily having the time, or is there a bit of fear that if we teach you, okay, these are the data points we're looking for, this is why the property is a good candidate, that there's a fear that, for the next couple of purchases, they might feel like they can do it themselves? Because I feel like when you speak to someone super educated, what you actually do is you learn something, but you learn how much you don't actually know. So it
Yeah,
actually doesn't
yeah.
tend to work that way.
I think there's a bit of both. So there are buyers agents out there who have done very, very well for themselves. They're very, very smart, and a lot of people just really trust them. So when they say buy here, it's natural to say, yeah, well, I trust them because they've got such a good track record, and who am I to tell them that they're wrong? Okay, and that's fair enough. But and then when those buyers agents become so popular, and they've got that track record, then yeah, they just don't have the time to give that level of education or explanation. And to be fair to them, a lot of those properties still perform very, very well. With the education piece and clients going off and potentially doing it themselves, that's always going to be a risk. But at the same time, it's fair. Like, it's fair that if they do learn along the way and they feel like they have learned enough to go off and do it themselves, then yeah, fair play to them. And it's happened with some of my clients who have gone on to buy their next properties on their own because they felt they learned a lot from me. They felt empowered, and they said, "Look, thank you so much for everything you've done for me, Eric. I've learned a lot from you. I'm going to do the next one on my own." And I said, "Look, that's perfectly fine. But if you need help, then, or if you don't have time, then I can still help you with your next one." So for me, it's more about just making sure that they have a good experience working with me, and if they do feel like they can do it on their own afterwards, then yeah, fair play to them.
You're a fairly considered, quiet-spoken, intellectual sort of fella. Don't strike me as an extrovert. Yeah, well, I'll send you the address for the check, mate. How do you sort of balance the passion that you have for sharing your knowledge and trying to differentiate yourself from the sea of kind of self-promotion and the heavy advertising that we're seeing in the space at the moment?
Yeah, it's a tough one because I've never been one to overly promote myself. Like when I was in the corporate workplace, I've always just been more of a quiet achiever, and I just let my work kind of show for itself. But
Yep.
now that I am in the real estate and the buyers agency space, I do have to kind of showcase my work a lot more. So when I do that, it's more focused on I guess, here's what I've done, here are the outcomes I've achieved for my clients. And if that resonates with you, then, let's have a chat. But I also note that there's, the buyer's agent industry has been around for quite some time, and there's a lot of really, really clever minds in the industry who, I've learned a lot from as well. And for me, I'm not here to say that I'm a guru and that I'm just like them, or I'm going to be better than them. It's never about that. It's more about me saying that, look, I'm an experienced investor, and I've learned a lot of lessons along the way, and I just want to share that with others. Whether I know a lot or just a little bit, if I can share just what I know with others, and that helps them along the way to, I guess, not make that one extra mistake, or just get that one little 1% gain to help them on their journey, well, then that's what it's all about for me. It's not about me trying to be the best or have the loudest voice in the industry. It's just, sharing what I know with others and sharing what I've done with others. And if that resonates, then that's great. Yeah.
So if we check back in 10 years and you're doing videos stood in front of a Lamborghini, this isn't going to age well. But I don't think we're going to have that problem.
I'd love a Lamborghini though, no matter what people think of me. Nah. I'm probably not going to do that. Yeah, to be honest. Yeah. Yeah.
I want to ask the question about the inquiries that you're getting as a buyer's agent, because I've observed a few different things, and I'm wondering what people come to you in terms of engaging you, saying, Eric, I want you to do this, or I'm looking at that, or I need to go buy something fast, or this market's going, like we need to get in there quickly. Because I've observed something that I'll call the Perth effect, is that there are plenty of investors that got into Perth at the right time and made a hell of a gain in a short amount of time. And it does feel now like we're so hyper focused on the sugar hit of short-term growth, we're ignoring the long-term growth, and Perth still hasn't outperformed other capital cities if you expand to a 10-year time frame. It's just that rapid pace, and that's leading people now to go to places like Darwin that, you know, has a relatively speculative market that is characterized by big peaks and then long periods of nothing. What are people coming to you asking, or they have a preconceived notion of the type of property that they want, and how do you kind of deal with those?
Yeah, most people come to me asking for help with buying the right property to help them build out a big portfolio. So a lot of them are buying their first or second property and they want to build a portfolio of, like, you know, you start with 2 or 3 and maybe it grows to 5 and you see how you go from there. And then they just want my advice on what's the best property to achieve that. So for me, it's all about just, like, once again, giving them the education on what type of property would be suitable for that. And for me, it's always about long-term growth, a property that has, you know, like the potential to grow in the short term so that you can, you know, get that, you know, equity increase, unlock the equity and go again so that you don't have to buy, so that you don't have to save another cash deposit. But then I also want to make sure that that property has the legs to grow in the long term so that, you know, it can potentially double in value over the space of 10 to 15 years, because that is where the real wealth is being made. Because there's no point in it, you know, doing really well in the short term, then you taking equity out and then it does nothing for the next like 7 to 10 years, right? It's about making sure that it constantly grows. So for me, it's about explaining that to them, educating them on the types of properties that I recommend. You know, if they do want the hype of going for a short-term market because they're in a rush to build that equity, then yes, I can recommend markets that are primed to do that. But then I'll always give them the full picture as to, hey, we can do this in this market, but then there is a risk that it may not continue to have the legs to do that in the long term. So it's about just managing expectations. It's about educating them, giving them that full picture so that, you know, when they do agree that, yeah, hey, we're going to buy in, say, Darwin, they know what the risks are, right? Not that I'm buying in Darwin, by the way. Yeah. Yeah.
I'm interested in, I suppose, tying a bow on this episode. You've shared you've had this you know, quite good success in a relatively short space of time, yet you're humble enough to say, look, if I did it again, I'd do it differently. I definitely made mistakes, but mistakes can be overcome. I'm just interested in your best advice for investors that are in that situation, that do have a goal for building a relatively large portfolio, but are in those early stages in that first or second property. Is there any sort of key insights that you would say, look, these are the things that you need to get right as the bread and butter, and everything else will fall into place?
Yeah, for me, the biggest advice that I have for investors who are in their early days, whether they're buying their first investment or second, the biggest advice I have is just getting educated. Okay, so that, you know, eventually when you do buy your first or second property, you make a very informed decision. Okay, so so get educated or get professional help, okay, from someone like a buyer's agent. Now, if you want to do it yourself, then again, make sure you get educated. And there's a lot of, you know, free content out there on Facebook and YouTube. There's paid courses as well that can really help you along the way if you want to go that next level. But if you don't have the time, then definitely get professional help to make sure that, you know, you are making the right decision eventually when you make that big purchase. You know, and yeah, if you get professional help, then maybe get help from someone who can educate you along the way as well, so that you feel comfortable with what you're purchasing. That's my biggest piece of advice for those who are in the early days.
Yeah, awesome. I think some excellent advice for anyone in that situation. And to finish us off, what's the future look like for yourself and your portfolio and your business? What are the goals? Because I think often that's missing when people are saying, I want to build a portfolio. And then you ask the question, why? I'm like, oh, no, because that'd be good, wouldn't it? You know, like
Yeah.
there's no exact plan of, you know, retirement income, or I want to go on holidays or do this for my children or what have you.
Yeah, I think for my portfolio, I'm looking to buy another couple of properties, one or two properties to replace that dud in Blacktown that I sold off last year. So I'm looking for my seventh property and an eighth to build out that portfolio, so just so I could finish off that accumulation phase. Once that's done, I'll kind of probably just focus on holding on to them, maybe getting into some renovation projects to maybe buy a couple of renovation projects and flip a few properties, make some quick equity gains to pay it down. I'm also looking to buy a property in my SMSF and build my wealth within that environment as well. So that's kind of the goals for my portfolio, just to kind of wrap up that accumulation phase. For my business, the biggest focus is just to continue just doing good work for clients, because I do think that for me, I just want to naturally grow the business, by doing good work and not necessarily scaling it too quickly, at the risk of not delivering a good quality service. So just do some more deals for clients, look after them, and steadily grow the team so that I can just help more people.
Yeah, awesome. I love that. Well, I'm looking forward to checking back in with you in the next little while, Eric, and thank you very much for sharing all of that gold today. I'm sure everyone's going to get a lot out of it, so thank you very much.
No worries. Thanks, Mike.
Cheers.
See ya.